right now. It's recording now. Okay.
Thank you so much, Larry. Good afternoon, everyone, and thank you for joining to our today's presentation on tax update. I am happy to partner up again with Larry Pon to do this presentation. And we only have 1 hour, and I'm sure we have a lot to cover. Larry will be talking about the latest tax proposal and help us be ready for this tax season. Believe it or not, April is very close by. So with that, Larry, I'll just give the stage to you, and let's dive into this interesting subject.
Okay. Well, thank you, Katerina. And hello, everybody. Thank you for being here. I just put in the chat a link to a Google Drive, which is a copy of this handout. So if you want to download a copy for you to take notes or whatever, it's in there. I might post it again for people who show up a little later. And happy to take questions while we're doing this, and use the Q&A feature. So the Q&A on the bottom there, and Katerina will monitor that as we go along. So a little bit about me. I'm a CPA, a personal financial specialist, certified financial planner, enrolled agent, United States Tax Court practitioner, and an accredited estate planner here in Redwood Shores, California. And I've been doing this since 1986, and I loved talking about taxes. So just really enjoy doing this. So today we're going to talk about three main topics. Update on 2021 tax forms to get ready for this coming tax season, how to be prepared for that. Talk about some recently passed legislation. What tax laws have been passed? And boy, Congress has been busy. And we're going to close with proposed tax legislation, give you an update of what to expect, what's going on, an update of what's going on in Washington, D.C. So let's get started. Let's start with the 2021 tax forms. So no substantive changes this year, which is a good thing. So the forms look very similar to the previous year forms. They went through a significant change in 2018. It was kind of hard to read because the government said that taxes will be so simple that you do it on a postcard. Well, that didn't really happen, did it? So no more postcard. So the way the tax returns are now structured is a form 1040, 2 sides plus schedules behind it. So about 5 pages behind it, and that's the tax return. So for 2021, what's one change? Well, on the front of the 1040, right underneath your name, address, and social security number is a question. At any time during 2021, did you receive, sell, exchange, or otherwise dispose of any financial interest in any virtual currency, cryptocurrency, those sorts of things? In 2020, instead of the word dispose, it was acquire. So they changed the word dispose, slightly different, but this tells you how important virtual currency is to the IRS. So you need to truthfully answer this question, because if you don't, the IRS will send you a series of 3 letters. The first letter would say, we think you got some cryptocurrency. The second letter would be, we know you have cryptocurrency. And the third letter is, we know you have cryptocurrency and you owe us taxes on it. So you want to avoid those letters and report it up front. We'll talk a little bit more about virtual currency because it's a big deal now. It's a very big deal. Line 12 of the 1040, it's a standard or itemized deductions and charitable contributions. So in 2020, you could take up to a $300 cash charitable contribution if you don't itemize. That's if you're single and if you're married. Well, they made that correction for 2021. It's for married and single. Oh, no, for single, it's $300, $600 for married filing jointly. Now, you can't just automatically plug in $300 or $600. You have to have legitimate charitable contributions with the substantiation requirements. You know, the thank you letters, the cancel checks, receipts showing that you actually made the charitable contribution. So don't make it up. The same rules still apply, but for 2021, if you don't itemize, which most people don't itemize, $300 for singles, $600 for married filing jointly. Here's a reminder of the standard deduction for 2021. For single or married filing separate, it's $12,550. For married filing jointly, it's $25,100. And for head of households, $18,800. If you're 65 or older or blind, you get an extra $1,350. or $1,700 if you're unmarried and not a surviving spouse. So there's some extra to the standard deduction. So most people are not itemizing. So when it comes to tax planning with real estate, what's the value of your property tax deduction? What's the value of your mortgage deduction? So because of the higher standard deduction. Now for your children who are still your dependent, they're working, right? They're working. So they get if their claims dependent, their standard deduction is either $1,100 or the amount that they earn at their job plus $250, but not to exceed the standard deduction. So what that means is you have a child, dependent child working, they can make up to $12,550 and pay zero amount of taxes. So what's the tax planning tip here? Well, if you have a child who's working, who makes at least $6,000, you can put $6,000 into that child's Roth IRA. They're in a 0% tax bracket, and that money is going to grow tax-free for the rest of our lives, which is a pretty good deal. Moving on to line 27, the American Rescue Plan. That was the tax law change that happened in March of this year that made some changes to earned income credit. So line 27B is for the non-taxable combat pay election. And line 27C, most importantly, normally you take prior year earned income. Well, 2020 was a very unusual year because many people were either laid off or furloughed or had substantially less income in 2020 than 2019. So with the change in tax law, you can use the 2019 earned income to possibly get a higher earned income credit. Line 28, the refundable child tax credit or additional child credit. That's on schedule 8812. This is new for this year because as a result of the American Rescue Plan, the child tax credit is now refundable. Before 2021, it was a non-refundable credit. So what's that? What does that mean? So if it's a refundable credit, it means that, for example, let's say you have $6,000 of child tax credit, but your taxes were $4,000. So if it's a refundable credit, you get a $2,000 refund. If it's a non-refundable credit, you can only use it to the extent of your tax liability, which would be $4,000 resulting in zero, and the remaining credits are just lost. So that's a big change this year. It's line 28. And we're going to be talking about the advanced child tax credit payments. So that's going to be a significant change for the 2021 tax returns. Line 30, recovery rebate credit. That's the third stimulus payment, the third economic impact payment. So if you didn't get it, then you report on line 30 to get the recovery rebate credit. If you did get it, don't put it there. And for last year's taxes, that was incredibly confusing. A lot of clients says, oh no, I never got it. I never got it. Okay, so we put it down the form and then we get a letter from the IRS saying, oh yes, you did. Oh yes, you did. So you got to be careful about that. We got to keep an eye on that. And we'll talk about the important letters you don't throw away in January when you get them from the IRS. Then we move on to Schedule 1. So Schedule 1 is the additional income and adjustments to income form. What I really like about the changes this year was in the past, it just said other, other. Well, what's other mean? Well, they broke it out other, and I didn't list them all. I just listed the more interesting ones. So part 1, line 8, what used to be other, now they've broken it out for us. Line B is gambling income. That's when you win the lottery, you win at the casino, you get a form W2G. So be careful about that. You report the gross amount of your winnings here, and you deduct it on the Schedule A, your losses on Schedule A. You don't report the net amount. This is where people get in a lot of trouble. I won $10,000, but I spent $2,000 on bets. So I'm only putting down $8,000. Well, that's incorrect. You have to put the gross here and deduct it as gambling losses on Schedule A, not the net amount, the gross amount. Line C is cancellation of debt. That's reported on Form 1099A or 1099C. That could be forgiven mortgages, forgiven credit cards, any forgiven debt. That's income with certain exceptions. Line G is jury duty. Line I is activity not engaged for profit income. What is that? That's like a hobby. You do things for hobby. You make some money in a hobby, but it's not for profit, it's just you just happen to make some money this year from your hobby. Why is it important to report it here instead of somewhere else on the tax return? Because if you put it on Schedule C, it'll be subject to the self-employment tax. So that's why this is important here. Many of our clients have stock options. That's line J. Line K is an interesting one. Income from the rental of personal property. If you engaged in the rental for profit, but we're not in the business of renting such property. And that's people rent out their cars. Personal property is a car. Real property is like your home. Like people will rent out their homes on Airbnb, VRBO, and all those other type of apps. But if you're renting out your car, you're doing it for profit. Hopefully you're making money on that, but it's not a business. If it were a business, again, you'll be paying self-employment tax. That's 15.3%. So that's why this is important on line K. Line L is kind of interesting here. We had the 2020 Olympics this year. The 2020 Olympics occurred this year in 2021. If you won Olympic or Paralympic medals or USOC prize money, it's tax-free if your AGI is less than $1 million. However, if you have other award money endorsement deals, you get paid to have your picture on sporting goods and like and cereal boxes, that's includable in income. Then part 2 are the adjustments or above the line deductions. So line 11 is our teachers, educator expenses. So teachers, K-12 educators can deduct up to $250. The change for 2021 is that not only do you include classroom supplies, paper, pencils, and classroom supplies, also include PPE, personal protection equipment, face masks, gloves, hand sanitizer, those sorts of things are included as part of that $250. Line 24H and 24I, attorney fees and court costs. Normally, those are deductible as miscellaneous deductions. If you win a lawsuit, you can deduct the legal fees as a miscellaneous deduction. However, as a result of the Tax Cut and Jobs Act in 2017, miscellaneous deductions are gone for federal purposes. So you need to consider that when you're settling a lawsuit. However, 2 types of legal fees are deductible above the line. Attorney fees and court costs for actions involving certain unlawful discrimination claims, and in connection with an award from the IRS for information you provided that helped the IRS detect tax law violations. So those are whistleblower claims. Very complicated. If you want to turn someone into the IRS, if you want to turn in your employer, there's some pretty complicated process to follow. There are lawyers who specialize in that, and that will be deductible above the line. All right, so Patricia's got a good question here. What about attorney fees related to insurance claim on our home? That's a good question. It's going to depend on what the insurance claim is about, but generally, so let's say you have a settlement and you paid the lawyer a fee for it, and it depends on whether that settlement is going to be taxable or not. So there's some considerations to consider there. And in terms of the legal fees, they'll be deductible as a miscellaneous deduction, which are currently not in existence right now until 2026. So that comes back in 2026. So if you can push your lawsuit until 2026, then you can deduct it then. You can deduct it in your California return because California didn't adopt that change, but not for federal purposes. So to be specific, it's all about your case and all the details about that. Schedule 2 is additional taxes. Those are additional taxes. I just point out a couple of them are kind of important. Line 1 is Form 6251, the alternative amendment tax. And that's something that would apply to our clients who are employees of startups who have incentive stock options. So there's some planning we could do known as break-even planning. It's like how many shares can I exercise without incurring AMT? So there's some tax planning that goes into that. Line 2 is the excess advanced premium tax credit repayment. Those are for people who get their health insurance through the Affordable Care Act, also known as Covered California here in California. And if you got an advanced premium tax credit, if your income's too high, you'll have to pay it back. In 2020, you didn't have to. That was the big change in March of last year, was that for 2020, you didn't have to pay it back. So quite a few people dodged a bullet with that. But for 2021, you do have to pay it back. So don't forget about that. Part two is other taxes. There are no new other taxes, so nothing there. Part three, very important form, additional credits and payments. So why are credits important? Well, every dollar of credit reduces your taxes dollar for dollar. So a credit's worth a lot more than a deduction. A deduction reduces your taxable income, which then is applied against your tax rate. So don't forget about the credits you're entitled to. The American Rescue Plan enhanced and made refundable the credit for child and dependent care expenses. We'll talk a little bit about that in a second here. That's reported on Form 2441. That's for paying for daycare for your children, or if you have dependent parents, you're paying for care for them. Line 3 is education credits. That's the American Opportunity Credit, lifetime learning credits. If you have children who are in college, that could be worth up to $2,500. So it's a pretty significant tax credit. The retirement savings contribution credit. So if you're, for most of our clients, they're not going to be eligible for that because their income's probably too high. However, if you're retired and you're working part-time, you're bored, you're working part-time, you qualify to put money into an IRA, go ahead and do that because you might get a retirement savings contributions credit. That's worth could be a few $100s. Credit for prior year alternative minimum tax. So if you paid alternative minimum tax in the past, there's a credit. So for most people, they might have burned through it in 2018 and 2019 because they were liberalized in those years. A lot of people are getting electric cars, Form 8910 and 8936, the alternative motor vehicle fuel credit, and the qualified plug-in motor vehicle credit. So how would you know if your car qualifies? Well, if you buy it from a car dealership, your salesman's definitely going to tell you about that. So they'll tell you everything there's to know about that. Or otherwise, you can go to the Department of Energy website. They'll have a list of all the cars, the models, and what the credit's going to be. It's on the Department of Energy website. Another credit that you shouldn't forget about is the Alternative Fuel Vehicle Refueling Property Credit, Form 8911. That's if you put an adapter into your garage to plug in your electric car, or if you have a natural gas powered vehicle, outlet in your garage to plug in the natural gas for your car, you get a credit for the cost of putting that device in your garage. So it's worth up to $1,000. So it doesn't hurt to do that. So it's those little power stations you put in your garage. All right, let's talk about the child and dependent care expenses. So that's been enhanced. It's made refundable now. And most importantly, the percentage has been increased from 35% to 50%. And most importantly, look at the costs. It used to be $3,000 a child, up to $6,000 for multiple kids. Now it's $8,000 per child, up to $16,000 for multiple children. I'm sure that still doesn't cover the cost of daycare, but it's a step in the right direction. And there's some phase outs depending on your income here of taking advantage of this credit. Also, as part of the American Rescue Plan was the flexible spending amount has been increased from $5,000 to $10,500. And that's reported on box 10 of the Form W-2. So, it's been enhanced this year. I know we're a few days left in the year, but make sure you max out on that and take full advantage of it. The other big change for 2021 is the advanced child tax credit payment. So what happened is that as part of the American Rescue Plan, the IRS was sending checks to people or direct deposits starting in July 15th. And so if you have children of 6 or under, it's $300 a month for each child under 6. And I know some families with 5 kids under 6. It's amazing. I don't know how they do that, but they do. So let's say if you have 5 kids under 6, 5 times 300, that's $1,500 a month you're getting from the IRS starting in July. If they're between 6 and 17, that's $250 a month. So it's July 15th, the 15th of every month. The last one was December 15th of 2021. So you're probably asking, what about January? Are we going to see another check in January? Good question. That law has not been passed yet. And the deadline to pass that law is December 28th. It's not going to happen. So we're probably going to get some angry citizens saying, hey, where's my check? So anyway, we'll talk about that a little later here. So the American Rescue Plan increased the child credit. That you hear this in the news. This is what's holding up the bill right now. It's a big deal. It was enhanced previously. It used to be $1,000 a kid. Remember, it was $1,000, and then the Tax Cut and Jobs Act bumped up to $2,000 per kid per child, and now it's $3,600 for children under 6, $3,000 for children between 6 and 17. The previous law was only up to age 16. You only got the credit for the kids under 16. Now it's 17. Now there's AGI limitations. So if your income's less than 75,000 if you're single, 112,500 for head of household, 150,000 for married filing jointly. So if your income's below 150, you will get the enhanced amounts. Now, if you're on the border of that, this is where some tax planning can come to play. What can I do to reduce my adjusted gross income to get below here so I can get this extra money? So there's some planning there. If your income's above these amounts, you'll still get the $2,000 per child credit. You still get the $2,000 for age under 17. And then that would also phase out at a much higher level of income. So the IRS looks at the 2020 line 11 of the tax return to figure out how much to pay for these advance payments. And then there's a haircut. You lose $50 for every $1,000 above the modified adjusted gross income. So here's the important thing. So in January of 2022, anybody getting these payments will get a letter 6419. It's not junk mail. It's not scam. Give it to your tax preparer. Do not throw it away. Your tax preparer is really going to need this. They're going to ask for it, and you better say, yes, here it is. Here's the letter. So 6419. What else did the American Rescue Plan do? Also provide the third stimulus payment. It's $1,400 a person, plus $1,400 for each dependent of that taxpayer. They had a pretty tight phase-out range here. If you're married filing jointly, it's income between $150,000. If your income's over $160,000, you didn't get the rebate. If it's below $150,000, you get the whole amount. For single, it's $75,000, and you phase out at $80,000. So it's a $5,000 margin there. And in January of 22, if you got your rebate, you get letter 6475. So do not throw that letter away. Your tax preparer is going to want that letter. So here's a quick summary of what the American Rescue Plan was all about. It was a $1.9 trillion bill that passed in March of 2021. Made some retroactive changes to the taxes, which caused us a lot of headaches and caused a lot of headaches with the IRS. So enhanced child tax credit, expansion of the earned income credit, expanded the child dependent care plan, had new tables for the premium tax credit. So more people got that. And if you had student loan discharges between 2021 and 2025, it's not taxable. Now, President Biden's under significant pressure from members of his party to enact student loan forgiveness, but it hasn't happened yet. He's been telling Congress that I don't want to do it because he can do it via executive order, but he wants Congress to write a law to do it. So we'll see what happens with any student loan discharges, but it's been on deferment. And so starting in February of 2022, student loan payments will start up again. So if your kids or you have student loans outstanding, be prepared to start paying them again. Starts in February. I still tell people to keep paying it now because there's no interest. So every dollar you pay is going to reduce the principal. Increase in the employer provided dependent care assistance we talk about. A couple of really significant COVID related items. So for people who got the EIDL loans, the targeted economic injury disaster loan advances, those aren't taxable. And restaurant revitalization grants, those are huge. And that's not taxable income. Some significant payroll provisions in here. We have the employee retention credit. That's a whole 8-hour seminar there. Paid sick and family leave credits, and the Paycheck Protection Program modification. So significant changes there. All right. I'm moving pretty fast here, Katarina. Okay, so just a reminder, for 2020, required minimum distributions were suspended. No RMDs for 2020. They're back in 2021, so don't forget to take them if you're subject to them. As a result of the Secure Act tax law change, the required beginning age is now 72, not 70 and a half, so age 72. If you forget to take the RMD, it's the most expensive penalty. It's 50%. Also, the rules for inherited IRAs have changed, and watch out for your beneficiary designations. Too many times, if I looked at clients' IRA accounts or retirement accounts, and I look at the beneficiary, I go, "Who is this person?" Oh, that was an ex-wife 2 ex-wives ago. So you want to make sure it goes to the right person. So there's some careful tax planning you need to do. More tax planning considerations for 2021 here is that we have 3 tax rates for capital gains. It could be 0 if your income is less than $40,000 for single, or $80,800. So you can have taxable income up to $80,800 and have 0 taxes on capital gains and qualified dividends. So that's a pretty big deal. There's some planning there. The top rate is 20%, and that's pretty high. 445,000 for single, 501,000 for joints. That's pretty high. So there's some planning we can do there, because for most of our clients, we're going to be in the 15% bracket for capital gains. So that could give us some opportunity for some tax planning here. And same thing, the big capital gains we see are from sales of homes. You know, you bought your home in 1960 for $100,000. Now it's worth a couple of $1 million. There's some pretty good capital gains there. So there's some planning we need to do for those capital gains. Big change in Social Security this coming year. Biggest increase in decades, 5.9% for 2022. If you're collecting Social Security, your benefits going up 5.9%. For 2021, the increase is only 1.3%, which is where it normally has been the last few years. So you're going to get a nice significant increase in your Social Security benefit. For if you're taking your Social Security before your full retirement age, FRA, you need to pay a portion of it back if you're still working. So for 2021, that's $18,960. For 2022, it's $19,560. So you lose $1 in benefits for every $2 in earnings above these limits. So the tip is, don't take it early. At the earliest, take it at your full retirement age. Otherwise, you're stuck with a permanent discount, and you're going to complain about, gee, my Social Security benefit's really low. Well, because you took it early. To file for nanny taxes, if you pay any household employees more than $2,300, you need to withhold nanny taxes. So don't forget about that. That's a real big deal. Standard mileage rates here for business, it's for 2021, it's 56 cents a mile. The 2022 just got updated to 58.5 cents a mile. So if you're driving for business, the deduction is 58.5 cents a mile. So for Katarina, as a realtor, you drive around a lot, that's a big deduction for you. Medico is 16 cents a mile for 21 and goes up to 18 cents in 22. If you're driving on behalf of a charity, you're delivering food, you're driving kids to church or whatever, right? It's 14 cents a mile. It's set by Congress, so it's only going to change with an act of Congress. And this is a few decades old. Okay, the Consolidated Appropriations Act. This was the tax law change in December of 2020. So we talked about the American Rescue Plan, which was March of 21, right in the middle of tax season. This was at the end of 2020, December 21st. Why is that date important? Because it was after that date, the government would have shut down. So they had to pass this law. So that's why it was December 21st. It's only 5,500 pages. It's a fun read. And it made a whole bunch of changes. It allowed for a second draw of PPP loans. Most importantly, business meals are now 100% deductible. So if you have lunch or dinner with a colleague, a client, a prospect, it is now 100% deductible. At the time this law was written, most restaurants had indoor dining closed. So the words were meals provided by a restaurant, which means you can take it to go. You can eat at the park, in the parking lot, in your office, or whatever. You can have it provided by a restaurant. And that includes food trucks. You can pick up food at a food truck. But what's not included? The IRS gave us some more details to that via notice 2021-25. They told us, yeah, restaurants, food trucks, those are okay. But I go over to the grocery store to pick up a packaged salad, or I go to the hot food section and scoop it up and all that, in the deli section, that doesn't count. So food from a grocery store does not count. And I always like to joke about those wonderful hot dogs spinning at the gas station. So do not buy hot dogs from the gas station because they would not be deductible. And also, I think they're really gross. So anyway, that's a big change for 2021 and 2022. And the point of why Congress put that in there was they're trying to revitalize the restaurant industry. So that's why they put that in there. That's the law that allowed PPE to be deductible for teachers and also updated the cash charitable deduction, $300 for single, $600 for joint filers. It made the medical expense deduction floor at 7.5% permanent. It was 10%, so which means you can only deduct medical expenses if it's more than 10% of your income. Now it's 7.5% of your income. They repealed the tuition deduction. That's the $4,000 deduction if you pay for tuition at a higher education. There's some disaster relief provisions here. I'm not going to go into this because it doesn't really apply in our neighborhood here. And also we have what's called extenders. Extenders are provisions in the tax code that expire every year. And so if these are ones that expired at the end of 2020, they're extended to 2021. So then you're going to ask me, what about 2022? My official answer is, we don't know because Congress has not passed the extenders yet. So we have the mortgage insurance premiums deduction. That's deductible in 2021. Don't know about 22. Health coverage tax credit, the non-business energy property credit. So if you got insulated windows, garage doors, and those kind of things, we get a tax credit for that. The fuel cell motor vehicle credit, the alternative fuel vehicle refueling property credit, and most importantly, the two-wheeled plug-in vehicle credit. Those are those electric motorcycles. Exclusion of the forgiven mortgage debts were renewed through 2025. So if you had a mortgage debt forgiven, the exclusion is reduced from $2 million to $750,000. So that's not taxable. The other extender was for residential energy efficient property credit because it dropped to 22% for 2021. Now the law updated to 26% again. So it's 26% for solar electric, solar water heaters, geothermal heat pumps, small wind turbines, fuel cell property, and qualified biomass fuel property. So it's scheduled to drop to 22% in 23, then expires after 23. However, in the Build Back Better Act, this was going to extend it. So we'll talk about that when we get to that slide. Okay. All right. So anyway, okay. The most recent law that was signed that affects our taxes was the Infrastructure Investments and Jobs Act. You've heard that in the news. President Biden had a ceremony in the Rose Garden on November 15th. He had a ceremony, HR 3684, and it's over $1 trillion of infrastructure improvements. We're getting a few dollars around here in the Bay Area, so be curious to see how quickly that ends up here. A lot of projects here that's going to finance. But to pay for all that, there are some tax changes in the infrastructure bill here. Number one is we talked about the employee retention credit. Well, they took it away for the fourth quarter. So except if you're a recovery startup business, so no employee retention credit. The big change, many people are upset about this, is expand the cryptocurrency reporting requirements for cryptocurrency brokers starting in 2023. Which means you'll be getting a Form 1099-B for your virtual currency transactions. So this bill had nothing to do with the tax increases. That's going to be in the budget reconciliation bill we'll be talking about next. So on December 2nd, Congress approved an 11-week stopgap spending bill. Why December 2nd? Because on December 3rd, our government would have shut down. Yep, our government was shut down. So on December 2nd, they passed the bill, which takes us to February 18th. That's right, February 18th. So if the Congress doesn't get their act together by February 18th, we will have government shutdown. So Congress will need to adopt another continuing resolution. So how'd you like to run your business like that? Keep it going for every few weeks. Or if they do the responsible thing, they passed a dozen appropriation bills that will fund the federal agencies through 2022 fiscal year. So the biggest one is the defense budget, and that's kind of making some progress right now. So right now, the defense budget is moving there. That's one of the dozen bills. So they got one making action there. Not ready for the president to sign yet. Then we heard about the drama of the debt ceiling, So Treasury Secretary Yellen said, you better raise the debt ceiling by December 15th, because if you don't do that, we're going to start defaulting on our debts starting in between December 21st and January 28th. So on December 16th, President Biden signed the bill that raised the debt limit by $2.5 trillion. So it's like $31.8 trillion. Yeah, try writing those zeros out there. I don't know about your credit card. My credit limit's not that high. That's the credit limit of the government. This takes us down out to 2023, right past November of 2022. That 2.5 trillion number was intentional so that this doesn't become part of the debates during the elections in November of 2022. So we'll deal with this again in 2023. Congress kicking the can down the road. All right, let's talk about cryptocurrency. So there's going to be new reporting for digital assets acquired after January 1st of 2023. So we'll be seeing new forms, hopefully by December 31st of 23. So we should get some forms. But what this legislation does is there's going to be penalties for non-compliance. So we're making this more established now, which means penalties are starting to apply. The application of the Bank Secrecy Act, and that applies to artwork, collectibles, and this hot topic known as non-fungible tokens, NFTs. So businesses that transmit digital assets will have to file Form 1099. Digital assets, we're going to learn more about these. Cryptocurrency, blockchain tokens, utility tokens, visual and audio works in the media, non-fungible tokens, NFTs, and other cryptographic representation of value. And so if each transaction is 10,000 or more, it will be reported on Form 1099. And also the law clarifies that no 1031 exchanges for digital assets. Some other changes that are made by the infrastructure bill. One of them is the automatic extension of certain deadlines for taxpayers affected by disasters. We had the first one, unfortunately. Law just passed November 15th. We just had the first one last week or this week. The tornadoes that covered 250 square miles of area. So those people will have a automatic 60-day deadline to file their tax returns, pay their taxes, and other deadline-related matters. So before, there was a process that we had to go through. So there's a delay. One of these that's affected by locally here is the California wildfires. So there's some California wildfires. So those people have an extension to file their taxes and to pay them. In the people affected by Hurricane Ida, that's in New York and New Jersey, if you're in those counties affected by Hurricane Ida, they don't need to pay their taxes that were due back in September until January 3rd. Their taxes that were due on October 15th, they got till January 3rd to file those taxes. So when there's a disaster, you get an extension. In Texas, they were affected by the winter storms, so they didn't have to pay or file their taxes until July 15th. So this is a very important change. And what's new is we have this new category called significant fires. We never had this term in the tax code before. Now we have something called a significant fire. And if you're affected by a significant fire, your tax deadlines are delayed. So that's new. Also, for our taxpayers who are in combat zones, they got automatic extensions to file their tax returns and to pay them. But there's some items that was missed. So this legislation kind of adds a couple more items regarding the tax court and any petitions with the government. So they have a little more time to do that now. All right. So in our remaining time, we're going to talk about pending legislation. So what we talked about previously is what is law? It's in the law. That's what we're living with. That's what we got to deal with. So let me give you a big warning here. We're going to talk about the Build Back Better Act. It's not law yet. President Biden has not signed it yet because it was passed by the House of Representatives on November 19th, $1.5 trillion. The tax portion is only 881 pages. It passed 220 to 213. So it's a pretty narrow margin there. It's a social spending bill. So it's got universal preschool, a lot of green energy incentives, a lot of tax credits related to that. And most importantly, an increase in the SALT limitation. That's the state and local tax deduction. So it's passed by the House of Representatives. So it is now at the United States Senate. The United States Senate has to vote for it. So what's so interesting about the United States Senate? It's 50 Republicans, 50 Democrats. So it's 50-50. So normally to pass a bill in the Senate, you need 60 votes. Well, this bill is not going to get 60 votes. So it's going to be passed by a process called budget reconciliation. So it's a law that's been around with us since 1974. And all you need is majority vote. So you need all 50 Democrats to vote yes on it. And then the vice president, who's the president of the Senate, is going to vote past the tiebreaker. So that's how this law is going to pass. Well, guess what? We've got one senator, Senator Joe Manchin, who is got his arms crossed, and he's been negotiating with President Biden this week, and he's going to negotiate some more next week, who's kind of holding up this bill. He thinks the bill's too big. This bill started at $6 trillion. $6 trillion. And by the summer, it got trimmed down to $1.85 trillion. And by the time it passed the House, it's $1.75 trillion. So it's gone through a bunch of iterations. So the versions we saw earlier is substantially different. We'll talk about the differences there a little bit later. So under budget reconciliation, it's a very specific process. And there's a very important nonpartisan person known as the Senate parliamentarian. The parliamentarian's job is to determine what belongs in this bill and what does not belong in the bill. So, Congress is known for Christmas trees, sticking all kinds of ornaments on the bill, totally unrelated. Well, the parliamentarian's job is to prevent that. So two controversial items that some Congress members want in there, it's not going to be in there. It's the immigration bill and the prescription drug bill. So that's probably not going to happen. So with budget reconciliation, there's no filibuster and the amendments are very limited. So that's what they're working on right now. It's an easier way to enact controversial budget and tax measures. We've gone through this in 2017 with the Tax and Jobs Act, and we've gone through this before decades ago. And so this is nothing new, but this is the shoes on the other foot now. Now it's on the Democrat side of things. Lots of tax changes in the Build Back Better Act, lots of corporate tax changes, a lot of international tax changes. I'm not going to go over them here because they probably have no impact on you personally. So I'm just going to focus on what's affecting you personally. So let's talk about the individual tax provisions. So what was in the previous version of the bill was an individual tax increase, bumping up the individual taxes to 39.6%. The current top rate right now is 37%. That got taken out. Also, in the previous version of the bill, was increasing capital gains to 25%. President Biden wanted it 39.6, but it was 25% effective September 13th of 2021. That got taken out. So those two provisions are out. So no tax increases, except for this right here, the income tax surcharge. So there's an additional 5% tax if your income's over $10 million. If your income's over 25 million, it's an extra 3%. So, that might not affect you and me, maybe a couple of you, but maybe not you and me. However, it could affect many of our trusts and estates. $200,000 for a trust or estate, that's the extra 5% surcharge, or $500,000. That'd be subject to 3% surcharge. So one question I have, which I don't know the answer to, and we haven't heard the answer to it yet, is, oh, okay, fine. I'm going to chop my trust into smaller trusts so my income will be lower. Can I do that? We haven't gotten guidance for that, and we probably won't. So that's going to be an interesting question to get around it. Can I break up my trust into little trusts? Another tax change to increase taxes is expanding the net investment income tax. Currently, the net investment income tax is a 3.8% surcharge if your income's over $200,000 if you're single, $250,000 if you're married filing jointly. And it's on your investment income, interest, dividends, and capital gains, investment income. Well, they want to expand this to include S corporation, partnerships, and LLC income. And so that won't be exempt from the net investment income tax. And that's for people of income over $500,000 for joint filers and $400,000 for head of household and single. The other change they want to make permanent is excess business losses. So as part of the COVID or Coronavirus Relief Act, they suspended the excess business losses and then they put it back in. So it's currently you can't have excess business losses through 2026. The BBBA is going to make that permanent. So no excess business losses. State and local tax deduction. That's for deducting your property taxes on your home, your state income taxes, and personal property taxes. As a result of the Tax and Jobs Act, so from 2018 to 2025, it's $10,000. I've seen people pay $350,000 in state and local taxes, but they only get a $10,000 deduction. The BBBA increases it from $10,000 to $80,000, and it goes to 2032. And then in 2030, after 2032, it drops back to $10,000. Is this going to stick? Probably not. So don't get too excited about this $80,000 deduction. Bernie Sanders is against it. He wants to put an income limit on this. So if your income's over $400,000, you don't get this $80,000 deduction. Senator Menendez, he wants to make that $550,000. So we'll see what happens. There's going to be, we're sure that's going to change. All right, child tax credit. We talked about that earlier. So President Biden wanted that child tax credit to go to 2025, to extend to 2025. That was his plan when they enacted the American Rescue Plan. And that was the earlier version of the BBBA when it was $3.5 trillion, and it's been trimmed down. So it's only to 2022, extended to 2022. The refundability goes on after 2022, but no more advance payments and no extension of the increased amount. So that's the way it's written right now. So what this means is starting in January 15th, you'll still get your $300 per child or $250 per child. The other change is that for 2021, if you lived in a U.S. possession, Puerto Rico, what are U.S. possessions? Puerto Rico, Guam, you don't get the advance payments. For some reason, you didn't get the advance payments. Well, you will under this bill. So that's one change. So we'll see if this is what's sticking right now. This is what's holding up the bill. This one page here. So maybe this gets deleted. Who knows? The earned income credit, expand that to 2022. The healthcare credits, expand those to 2025, because right now it's only to 2022. And the credit is increased from 80% of qualified health insurance from 72.5%. So that's trying to make that go to 2025. This is the part I want you guys to get upset. I want you to get upset here. I want you to get upset. I want you to call your members of Congress. They might not know what you're talking about, but print out this page and circle it and send it to them. Part of the bill is going to give the IRS $80 billion over the next 10 years. The IRS is significantly undermanned right now. There are 15,000 employees short. That's why we're having so much trouble. You can't even call them. They even on their website, it even says, don't call us. Don't call us. So they're still working on 2019 tax returns right now. They're still working on 2019. So the pandemic has not been good for the IRS. So there's a tax gap. And this 80 billion is supposed to help close the tax gap. And many members of Congress, this means there'll be a way of collecting more money without raising taxes. So that's the hope there. So it's going to be more backup withholding rules to third-party settlements. Most classic example is when you sell a piece of real estate in California. You sell, let's say it's not your home, it's a rental property. State of California withholds a portion of the sales price. If you're a non-resident of the United States, when you sell a piece of real estate here and you see a piece of real estate in the US, the IRS withholds some taxes from that. Well, they're going to expand the withholding rules. So we're going to see more of those, and we'll be dealing with our title companies when it comes to the withholding, because, I've gone through this with clients where, like Katerina was saying earlier, it's more important for clients to talk to us ahead of time than afterwards. I had a client who sold their house in San Carlos for a very large gain. Well, the husband decided to give all the money away to the kids. He gave all the money away to the kids. I said, you've got a tax bill to pay here. You need to get some money back from the kids. And you know how easy that is, right? Well, he couldn't get any back. So anyway, he owed a pretty big tax bill. So don't give the money away to the kids yet, all right? Let's wait till you figure out the taxes first. Okay, here's the part to get upset about. Back in 1998, there was a huge scandal at the IRS, which had hearings in Congress, people crying in the chambers and all that because of IRS abuse, because there's rogue IRS agents just abusing taxpayers. So we had the IRS reforms in 1998, which put on all kinds of changes. Well, they want to undo one of those big changes, allow the IRS more freedom in assessing certain penalties. What does that mean? It means that currently, if an IRS agent wants to assess a penalty on you, they need to get it signed off in writing by their immediate supervisor. So you can't get hit with a penalty unless a supervisor signs off on it. This tax law change will eliminate the supervisor approval. And what that means is an IRS agent can just go crazy. They open the book and say, hey, there's a dozen penalties I can charge. I'm going to charge you of all of them. Doesn't matter if they're right or not. So, before you had a supervisor's going to review it. Says, well, yeah, this penalty makes sense. This penalty doesn't make sense. Well, you don't meet the requirements of this one. It's another person to review it, right? So, okay. So please mention this to your Congress member. This got snuck in there. I know what they're doing here. This was a way they can raise some more money by imposing penalties. Of course, it's always to the people who can least afford them. So outrage here, outrage. Okay. Thank you for letting me outrage. All right. Green energy, a lot of green energy provisions. I didn't list them all here. A lot of them I don't quite understand because they use words like sequestration and those kind of things. So, which most of us probably won't get personally involved with. But credit for non-business energy properties modified and extended to 2031. So that's for energy efficient windows and doors, and the lifetime minimum maximum tax credits replaced. That $200 to $300 or $500 lifetime credit. It's an annual credit of $1,200. So, so maybe you do those windows first, get your $1,200, and you go to the other side of the house and do those windows and get $1,200. So, Residential energy efficient property credits extended to 2033. That's for solar panels, windmills, and those sorts of things. Plug-in electric vehicles, extend that to 2031. Eliminate the limitation on the number of cars. So right now, for example, for Toyota, they ran out of cars a long time ago. Teslas have hit the limit on cars. So eliminate that limit so you can still get credits. Increase the base amount of the credit. The next line here is a bit controversial. Further increases for vehicles and batteries produced at certain U.S. facilities, such that the maximum credit is $12,500. Those are for American-made union factories. So if it's a union-made vehicle, you get this higher credit. If it's a non-union, such as Tesla, it's a lower credit. So Mr. Musk is not too happy about this credit. And a lot of those new electric truck companies, they're not union. So we'll see what happens with that. A new credit for previously owned plug-in vehicles, because if you buy a used car, you don't get a credit, but there's a new $2,500 credit. For your business, like if you have trucks and those sorts of things, you get a 30% credit on commercial electric vehicles. So some clients are saying, can you wait? Maybe wait till next year to buy that truck. I know you need a truck. Why don't you wait till next year? We might get this 30% credit. That's worth a lot. So that could be worth a lot. Electric bicycles, all kinds of credits for electric bikes and reimbursements. Okay, here's the bad part about it. So disallow Roth conversions. So that's a very popular thing we're doing right now. It's Roth conversions. And that's not a typo. That's effective starting in 2032. So 2032. So why did Congress do that? They want you to do Roth conversions now so they can collect the taxes on Roth conversions. And then after 2032, no more. Here's the other urgent matter. No conversions for after-tax dollars. So which means no more backdoor Roth IRA conversion and no more mega backdoor Roth IRA conversions. So I told some clients, you better top off your after-tax 401ks now in 2021. If you want to do the backdoor Roth, do it now, because you can't do it in 2022 if this law passes. So keep an eye on that. If you have more than $10 million in your IRA, you can't add to it. And there's a new 50% RMD rule. So if you have more than $10 million, let's say I have $12 million. Well, that's $2 million over the 10 million limit. 50% RMD means I got to take $1 million out. And this is effective in 2029. It's 100% RMD requirement if your retirement accounts are more than $20 million. So let's say I have $25 million in my retirement accounts. That means I have to take $5 million out. So that's what that's all about here. Oh, more heartburn here. Small business stock. So if your income's over $400,000, you can't take advantage of the exclusion of gain for small business stock. They want to impose the wash sale rules for commodities, foreign currencies, and crypto assets. So, so what's not in the bill? This is important here because it's important to know what's not in the bill. So the SALT cap repeal is not in the bill. No repeal of 1031 exchanges. We had a lot of heartburn over that. At the consternation of our environmentalists, no, the tax breaks are still in for oil and gas. Very favorable tax breaks for oil and gas. Fortunately, no elimination of step up in basis. We thought we were going to lose that. No increase in the estate tax rate. It's currently 40%. Bernie Sanders was going to raise it to 65%. No capital gains tax on death or transfer. So if you inherit the house, you would have to pay capital gains tax, no matter if the person who's giving to you is alive or not. No reduction on annual gifts. That was going to be reduced to $9,500 instead of the $15,000, and you're limited to 2 gifts. Right now it's unlimited. No FICA tax on S corporation flow through income. So that's what's not in the bill. What was in the bill, the September 13th version, and got taken out. No reduction in estate tax exemption. They were going to bump that down to 3.5 million. No limitation on the use of grantor type trust. That caused a lot of heartburn for estate tax lawyers. The stepped up basis for appreciated assets. Valuation discounts, no change in the use of discounts. The no restriction on the type of investments inside your IRA. They're gonna say you can't invest in assets that are required in accredited investors. No increase in capital gains rates. No increase in individual tax rates. Why do I have it listed here? This is all written already, so it's very easy to pop it back in. So so we just got to be aware of what's happening. So on December 13th, the Senate Finance Committee, that's the committee that writes the tax laws in the Senate, they released their part of the BBBA, and they made targeted improvements to it. It's over 1,000 pages here. No change to SALT yet. There's the corporate minimum tax, and they also have some agreement with the child tax credit. That's the Senate Finance version. Similar provisions to the international taxes and the green energy. There's some slight differences to that. So right now, today, it's not going to happen in 2021. It's not going to happen. Chuck Schumer, the majority Senate leader, wanted to have a vote by Christmas before they went home. Not going to happen. So the next deadline, not an official deadline, but an unofficial deadline, is the State of the Union address. That's like around January 20th or so, because President Biden wants to talk about some great legislation that's passed. So that's another deadline. The other important deadline is February 18th, because if we don't pass a bill by February 18th, the government's going to shut down. So there's some things to look out for. We don't have a whole lot of time to talk about tax planning. So I'm not gonna really talk about this because we're out of time, but we'll stick around to answer some questions, and I will turn off the recording in just a second, just to give you an update here on future appearances. So Katerina and I are doing another webinar, tax aspects of selling your home. So we're doing a webinar on that, talk about what can I do to reduce the capital gains tax, right? So we'll talk about some of those things there, and what goes in the cost basis, because I mean, someone sells their home. I think one tip I want to make right now is don't throw away your receipts. A lot of people want to clean out their homes. They say, oh, I need to just keep stuff for 7 years. No, you want to keep the receipts as long as you own the property. We're going to need to back up those improvements. Very, very important. And if you want to see me live, in person, in the flesh, January 20th at 3:00 at the San Mateo Public Library, we'll be doing a tax update, and we'll see what the changes are at that point. So we'll be giving this presentation on January 20th at 3:00 at the San Mateo Library. You can check the San Mateo Library website. They're the ones who are taking care of all the registrations and all that. So anyway, I think that's it for now. I'm going to stop the recording. Well, thank you for your time today. I'm going to stop the recording, and then I'll stick around to answer questions. So let me just stop the recording, and thank you very much.